August 2026. For the first time in nearly 3 decades, the United States appears to be doing something almost unthinkable. Not buying gold, not buying oil, not buying its own currency, buying Japan's yen. On the surface, it looks like Washington is helping an ally. But if that's true, why now? Because this isn't really about Japan, it's about America's $40 trillion debt. It's about a bond market that's starting to crack. And it's about a financial system so fragile that if Japan loses control of the yen, the United States could be next. Even more shocking, many analysts believe the famous photo showing U.S. Treasury Secretary Scott Bessent's handwritten note wasn't an accident at all. It may have been a message, not to Japan, to every trader on Earth, a psychological operation designed to move trillions of dollars without actually spending trillions. If that's true, then one leaked photograph may have revealed the next chapter of the global financial system. This video is sponsored by Plinko. It all started with a single photograph, just one picture. During a meeting in Washington, Reuters photographers captured a handwritten note sitting on the desk of U.S. Treasury Secretary Scott Bessent. The note contained only a few words: buy Japanese yen, JPY, $5 to $10 billion. Within minutes, the image spread across global financial media. Traders immediately began asking the same question: is the United States really buying yen? If the answer was yes, this would be one of the rarest currency interventions in modern history. The United States almost never enters the foreign exchange market to support another country's currency. The last major coordinated intervention involving Japan happened years ago, so why now? At first glance, the explanation seemed simple. Japan's currency had fallen close to its weakest level in decades. A stronger yen would help stabilize Japan's economy. America was simply helping an ally. But the deeper analysts looked, the less that explanation made sense, because there was one number on that note that immediately stood out. $5 to $10 billion. To most people, that's an enormous amount of money, but in the foreign exchange market, it's almost nothing. Every single day, the global currency market trades more than $7 trillion. Against that scale, even $10 billion barely creates a ripple. It simply isn't enough to permanently change the direction of the yen. If $10 billion can't move the markets, then why write it down? Why make sure photographers could see it? And why include something as basic as the currency code, JPY? As if one of the world's most experienced currency traders needed to remind himself what Japan's currency is. The more people looked at the note, the stranger it became. Instead of asking whether America was buying yen, analysts started asking a different question. Was the note itself the intervention? If that note wasn't an accident, then it wasn't written for Scott Bessent. It was written for the market, because financial markets don't move on money alone. They move on expectations. Imagine you're a hedge fund that has spent billions of dollars betting the Japanese yen will continue to fall. Everything is going according to plan. Then suddenly, a photo appears. The US Treasury might be buying yen. Now, you have a problem. Maybe the US never buys a single yen. Maybe they never spend a dollar. But can you really afford to keep betting against the Japanese currency if the world's largest economy appears ready to defend it? Probably not, and that's exactly how psychology changes markets. One hedge fund closes its short position, another follows, banks reduce their exposure, algorithms detect the shift in sentiment and begin buying. Soon, the market starts moving, not because of billions of dollars entering the system, but because millions of investors suddenly believe someone much bigger is about to act. Sometimes perception is stronger than intervention itself. Ironically, this isn't a new strategy. It's one Scott Bessent understands better than almost anyone alive. Before becoming U.S. Treasury Secretary, Bessent spent decades managing hedge funds. He worked under legendary investor George Soros and helped execute some of the most famous currency trades in financial history. He learned one lesson that every successful macro trader understands. Markets don't always react to reality. They react to what they believe reality will become. Credibility is often worth more than capital. If investors believe a central bank will defend a currency, they may stop attacking it before a single intervention takes place. In other words, sometimes the cheapest way to move a market is to convince everyone else to move it for you. But here's where the story takes a surprising turn, because this was never really about saving Japan. It was about saving America. To understand why, you need to look at one number: $40 trillion. That's now the size of America's national debt. Every year, Washington has to borrow more money just to keep the government running. And who has been lending America that money for decades? Japan. For nearly 40 years, Japan sold cars, electronics, industrial machines, and countless other products to the United States. In return, Japan received trillions of US dollars. Instead of letting those dollars sit idle, Japan invested them back into America by buying US Treasury bonds. Today, Japan remains one of the largest foreign holders of US government debt. That relationship has benefited both countries for decades. America gained cheap financing. Japan earned stable returns. But now, that relationship is under pressure because the weaker the yen becomes, the harder it is for Japan to defend its own economy. Eventually, Japan has only two options: raise interest rates or sell US Treasury bonds to buy back its own currency. Neither option is good for Washington. Higher Japanese interest rates encourage money to leave American assets. Selling US Treasuries pushes American borrowing costs even higher. And that's exactly what America cannot afford with $40 trillion of debt. So suddenly, keeping the yen alive becomes an American problem. But there's another question. If America wants to protect its debt market, why not simply say so? Why not announce a weaker dollar policy? Because doing that would create the very crisis Washington is trying to avoid. Think about it. If the US government openly admitted that it wanted a weaker dollar, what would investors do? Foreign governments would begin questioning the value of their dollar reserves. Large institutions could start selling US Treasury bonds. The dollar would fall much faster than policymakers intended, and borrowing costs would explode. In other words, you cannot publicly announce that you're going to devalue the world's reserve currency. You have to let it happen, slowly, quietly, almost invisibly. That is why many analysts believe supporting the Japanese yen serves another purpose. When the yen rises, the dollar automatically looks weaker against it. America doesn't have to officially weaken its own currency. It simply helps strengthen another one. The result is almost the same. A slightly weaker dollar makes American exports more competitive. Manufacturing becomes easier to bring back home. Large multinational companies become more competitive overseas. Most importantly, the adjustment happens gradually instead of overnight. No panic, no official declaration, just a slow shift that few people notice, at least until the effects begin showing up everywhere else. If this theory is correct, then the leaked note was never the story. It was only the first clue. The real story is much bigger. America is trying to solve a problem with no painless solution. It needs to finance $40 trillion in debt. It wants to rebuild domestic manufacturing. It wants to avoid a recession. And it wants inflation under control. The problem is, those goals don't naturally work together. Eventually, something has to give. Many analysts believe that something is the US dollar, not through a dramatic collapse, but through a slow decline over many years. History shows that governments facing massive debt often respond in similar ways. They lower interest rates, they increase liquidity, they create more money. No one knows exactly when that moment arrives. It could happen this year, next year, or much later. But if history repeats itself, the assets that governments cannot create out of thin air tend to outperform those they can. That includes gold, energy, land, commodities, and, according to many investors, Bitcoin. That doesn't mean these assets move in a straight line. Before every major wave of money printing, markets often experience fear first. Stocks fall, crypto falls, sometimes even gold declines temporarily as investors rush to raise cash. But once liquidity returns, the trend often changes dramatically. For now, the market is watching just a handful of signals: the strength of the Japanese yen, the yield on long-term US Treasury bonds, the US dollar, and the price of gold, because together, they may reveal what governments will never officially announce. Sometimes, the biggest policy changes are never spoken out loud. They're hidden inside small decisions, a quiet trade, a subtle intervention, or perhaps a single handwritten note left where the whole world could see it.